once a month. And then for Aqua, every other month or so. So it adds
Yeah.
up a little bit.
Yeah, it's still,
But yes, for my
Not
regular
much.
work,
Yeah.
going into my workflow for,
Oh.
yeah, it's a different.
don't even
one.
think about it.
Yeah. Well, and they've set it up so it's on my favorites bar, so it just goes right in.
Right, and I don't have to type in a password.
Right, and if I go from an email that I got a notification to approve, nothing. I mean, it just goes straight to the item. But I have to sign in the morning, and I'm getting the notice that I have to change my password. And now there's new criteria.
That's what I do.
Really helpful. As long as I don't forget that password key or password.
The key.
Yeah.
And it's always a good idea to update that one every once in a while too.
Because I haven't in a long time.
Oh, I don't have
Yours
it
looks
live.
different. Oh, oh. But it was worth it. Yeah, that's pretty much. It's all weekend. And then recovery. Yeah, and then recovery. There we go. Good morning. It is 10 o'clock, so we will go ahead and get our meeting called to order. This is the Oklahoma City MAPS Investment and Operating Trust, our meeting for August 21st, 2023. Moving on to item 2, approval of the minutes. They were included in your packet, so if anybody has any changes or corrections, please say so. If not, I'll take a motion in a second to accept as presented. Please cast your votes. Give us just 1 second.
She can verbally.
Do you just want to do a verbal vote on that as you're getting logged in? Okay. Okay. Motion passes. Thank you. Moving on to item 3, items for consideration. A, receive the quarterly investment report for the period ending June 30, 2023. Doug, how are you today?
Madam Chairperson, good morning. We've got good news today through the end of July, although since July to the present, we've seen a little downturn to the equity market, but I've got mostly good news here for as of June 30 and as of July 1. Remembering back that our time period here, we started investing April 1 of last year. We put it in two different tranches and getting us to where we are today. And we did that to avoid single day risk. And it helped a little bit, but last year was very tough. We couldn't avoid all of the risk last year. Just quickly going over market performance. This year's been great. Last year, remember, was awful. It was the worst year for a balanced investor, meaning stocks and bonds together, because bonds had one of their worst years ever. You will see that in the bond section of this chart. But looking at this for the S&P 500, the Russell indexes for the quarter, this is April 1 through June 30, S&P was up 8.7%. It's a great return for a quarter, much less pretty decent for an entire year. And that was the part of the market that was the strongest. Smaller companies did not do quite as well. Large companies benefited because of the technology rally, because of AI is resurgent, and folks are very enthusiastic about that from the investment standpoint. If we look at international equities for the quarter, positive but not as strong as U.S. equities, and that was led by developed markets. This MSCI Emerging Markets Index is mostly China and Taiwan. About half of the index is that. And if you've been following that, China's economic reopening post-COVID has been much slower than anticipated. And so their market is lagging behind. And really the troublesome part for lots of investors has been the bond market. Bonds are supposed to be stable returns, modest but stable returns. But since inflation has been the primary risk in the marketplace, in the economy, we have seen losses in the bond market. Losses in the bond market tend to be on a really bad year, about -2 or 3%. Last year was almost -18%. And we're on the way, well on the way, to having 3 negative years in a row for bonds, which is unprecedented. They're supposed to be the low-risk portion of the portfolio, sort of the anchor to windward when times are tough. But because this is the first time we've seen inflation since the late 1970s, early 1980s, market has reacted strenuously to this. So bonds are not doing great. We have a strategy that we implemented the last time that we all got together, that the additional allocation coming into the trust, which happened in July. We did not invest in equities. We did not invest in fixed income. We kept it in cash, and that's been helpful. I'll talk more about that in a moment. But we're in an environment where it pays more to keep your money in a money market fund or a short-term CD than it does to invest in a 10, 20, 30-year bond because of the market's shape right now. I'm going to go on to I'll talk a little bit about that. So looking at the bond results, this is page 9 of the report. This is normally positive, maybe modest returns, but positive returns. You can see that during the quarter, similar chart to what we showed before, the only part of the market that did well was U.S. high yield. So these are junk bonds, if you will. That was the old terminology for them. But those are more tied to the equity markets. Remember, equities are very strong during the quarter, but bonds did sell off towards the end of it. And as we go for the one-year rate of return, you can see that corporate bonds, positive 1.5% return. High yield bonds, again, the same positive return at 9.1%. And that's about all that was positive. So if you invested in mortgage backs are suffering because the interest rates on new mortgage-backed bonds are much higher than they used to. A couple of years ago, you could get a mortgage, 30-year mortgage, fixed rate between 2.5%, 3%. Today, it's 7%. So that's affecting the bond market also. Trailing year results here, the aggregate was down 0.9%. Global bonds were down more than that. We don't invest in global bonds here because that currency risk is not something that I think is appropriate for this investment plan. And then looking at the yield curve, well, I'm going to look at trailing one-year market rates. So this is the interest rate on various securities through the year, and you don't see a gigantic change except for the gray line. The gray line is the Fed funds rate. So this is the interest rate that the Federal Reserve sets for interbank lending, overnight lending, and you see that it's gone from, it was at 0 at the beginning of last year, and now it's all the way up to 5.25%, 5.5, or 5, effectively 5 1/8. And that's a dramatic rise, and we're still coming to terms with what that means. But what that does mean down here on the yield curve is that the yields on short-term or short maturity bonds is much higher than long duration bonds. And what that means is that this is a projection or a forecast, if you will. In aggregate, the bond market is expecting an economic slowdown. Also, higher short-term rates than long-term rates does have a slowing effect on the economy. But in many measures, even though the Federal Reserve has raised rates significantly and quickly, something we haven't seen in decades, the economy is showing more strength today than it was when they started, which is problematic. The world thinks the Federal Reserve is finished raising interest rates for the time being. I wouldn't be so sure of that right now. Inflation has come down, but it's not where they want it to be. Economic growth is high. Unemployment is very, very low. I just don't see inflation going down to that 2% level that is their target rate at current levels of interest rates. So that's something to be cognizant of as we move forward. Now, what that also means for us as investors, we can invest in a money market fund and get a yield of better than 5%, which is not something that we have been able to see since 2007, 2008, which is beneficial. What is our target rate of return here? It's 4% per year. So this is very helpful for us. We can have a low-risk investment that out-yields what our target rate of return is. It's a very nice tool to have in the toolbox that we haven't had for a long time. So we're going to talk about performance here and the history of the market value. So again, this is as of June 30. You can see at the beginning the total contributions on this. We had a 0 beginning market value as of April 1. Contributions of $80 million. We had withdrawals to pay fees. Gain and loss is negative as of this period of time, so negative $836,000. This is a much better picture than it was last quarter. We are improving, we are rebuilding. We remember this portfolio needs to have a stable foundation because we're not able to spend unless we have more than the allocation, the initial contribution to the plan. So over this time, April 1 of last year to June 30, the total return was negative 2.2%. And again, this is much improved from just a quarter ago. So we're not quite back to where we need to be, but we're getting closer, much closer. And remember, these are operational funds. These aren't construction funds at the beginning of a project. These are to manage the operational needs of the project. So allocation over time was quite similar. We allocated, you can see a slight bump down here, which is when we did have the second tranche added in, but again, this should be stable over time. And then our allocation by asset category, you can see domestic equity, 53%, fixed income bonds at 33.7%, international equity at 9.2%, and cash at 4%, $3 million. The target level for cash is 3.5%. But now, as I'll show you in just a moment, how this looks different as of July 31. We are fairly conservative when it comes to allocations. Equity, domestic equity is all in index funds. International equity is also an index fund, and our fixed income is actively managed. And then the cash is in a money market fund. Looking at where we are here on our allocation versus policy, our domestic equity is above target, but that's primarily because we have not yet funded the real estate investments or the alternatives bucket here. You have a provision in your investment policy statement that makes this okay. And wait until you see the one for next quarter because we're significantly out of target, especially on cash. I would anticipate making some moves in the alternative space and maybe actively managed spaces on domestic and international equity as we move through the year. Real estate, I think, warrants a 0% allocation now. But that's not to say that we will not be allocating to that in the next 18 months. Again, trying to build a solid foundation and expanding off of that over time. Let's see, I'm going to go into performance here. So we have a little bit of a mismatch here. The longest rate of return that we show is April 1 of 2022 to June 30th. And you can see here that that return is negative 1.78%. Our one-year rate of return, this is a different time period, so it was positive 10.91%. And that number in parentheses that you see to the right of that is your percentile ranking versus all public plans, right? So we're showing you versus public plans out there. 17th percentile means that you outperformed 82% of other funds out there. So that's a good return. We had a rough start, but we are sticking to our long-term plan, and we're compounding. As we go down the list here, you can see your investments for your S&P 500 index fund, 19.57%. Great result. Most of that was the first half of this year. You can see that the mid-cap index, 13.7, tracked its benchmark perfectly, and our small-cap index fund actually outperformed its benchmark index slightly. Our international equity tracked very well. Again, these are all passively managed versus benchmark indexes, and they've done an adequate job. When we look at our fixed income portfolios, it's fairly simple here. Dodge & Cox was up 1.82%. Its benchmark was down 1%, so that's a fantastic result. That ranked in the 3rd percentile of its peer universe, and over long periods of time, we should expect superior results out of this. The high yield portfolio, you can see, did underperform. They're a bit on the cautious side, and I think that's okay. I want my risky asset categories, I want the managers there to be a little bit less risky than their benchmark. But over long periods of time, you can see they've produced adequate results. And then cash at $3.19 million, 4%. I'm going to not go through the individual pages. I'm going to pause now if there are any questions.
Any questions? Yes.
When you said alternatives, could you give some examples of the types of alternatives you might add to the portfolio?
Sure. So the standard alternatives, if we go back a long time, since we have real estate separate from that, other examples would be private equity, private debt, venture capital. As this thing grows, we have a pretty open consideration of what would be alternative assets. Infrastructure is a good one because it's generally long-term fixed rate contracts, which we like that.
Nothing in energy?
That energy infrastructure
Okay.
could be, yes. So again, alternatives is basically anything that doesn't carry a market price, day-to-day basis. So, and we did separate that out between real estate, which is a bond substitute, except for now, and then other private assets. I would think private debt, given our return profile that we need here, I think that private debt, and there's a number of different ways to execute a strategy like that, would be something that we would consider.
But not Bitcoin.
Absolutely not.
Thank you.
Absolutely not. There have been a few funds who have invested in cryptocurrencies, and they have not done very well. So that's not an institutional grade asset as far as my concerns are. It was fashionable, but that was also an investment that did really well when interest rates were zero, and people were pushing the envelope on risk.
Yes, Kevin.
One other question.
Yes.
Would private debt be negatively impacted by, right now with what's happening with interest rates?
So you would not have wanted to start investing in it 2 years ago, but right now, I was with our private debt analyst last week, and he said that looking forward, there's risk, obviously, but the yields that are being generated right now, around 10%. So that's the opposite side of rising interest rates, right? If you have to hold from low to high, that's not good, but if you can start with high interest rates going in, that's not a bad alternative. Now, there are higher costs and liquidity issues that we all have to come to terms with, but that's starting to get my interest.
Other questions at this point, Bob? That's good. No? Okay.
I do feel obliged to go over fees because as fiduciaries, this is one of the very important things that we always talk about. The fees, this is page 35 of the quarterly report. You can see the total investment management fees, 17 basis points. Estimated annual fee in dollars at that $79 million mark is $133,000. This is extremely low. And that's primarily because of the passive management you have on the domestic equity side. Just to put it in perspective, private equity, hedge funds, et cetera, be about 2% plus a portion of your profits. This is 17 basis points. Okay.
Is that just the flat 17 basis points?
That's the weighted average.
The weighted
Yeah,
average,
that is
okay.
the weighted average. I think that if you did your peer universe or the peer funds in all of those categories, it'd be closer to, I'll guess, 80 basis points. So 4 times what you're
Yeah.
paying right now.
That's great. We like that.
Yes, we do.
Anything else? Hey, do you want to go ahead, or why don't we go ahead and vote to, are you
Okay.
finished with the June 30 report?
Yes.
Okay. So we need unless there's any other questions, we need a motion and a second to accept or to receive the quarterly investment report ending June 30. Please cast your votes. Okay, the motion passes. Thank you. So, moving on to the investment reports for May, June, and July.
We're going to hit the July report,
Okay.
if that's okay.
Yep.
So looking through the month of July, it was another good month for equities, not so great for bonds as rates continue to rise slightly. I want to compare and contrast the year-to-date sector returns. This is for the domestic equity market, and you can see the market has been positive, most sectors. Information technology and communication services running away from the other parts of the market. And that is because of AI and technology coming back into fashion. The index itself is up 20.65 through the end of July, so as dire and as negative as last year felt, this is a common pattern that markets go from significant weakness to noticeable strength, and this is why we hold on for long periods of time. You'll notice that there are 2 sectors that are negative, utilities and healthcare. Those are the most defensive parts of the marketplace. But if we look at last year, 2022, there are only 2 sectors that were positive, and it was energy, up 65%, and the next best was utilities, up 1.5%. So last year was different. The S&P was down 18%. If we look at the 1-year rates of return here, we have positive returns, double-digit positive returns, although the first half of last year was difficult. But when we look at our 3-year and our 5-year annualized rate of return for equities, they're back to positive. So just as bad and as quickly as last year felt, we had 3 very negative quarters in a row. We have since recouped those losses. Going into the return or the history of the value of the trust, you can see it changed. There were 2 allocations during the month of July, one $30 million and one $600,000. And those dollars were put to work just in a different way than we're used to. And you can see our allocation here. Domestic equity, 38.7%, international equity, 6.7%, fixed income, 23.8%, and cash, 30.7%. This is the new dollars that came into the portfolio. For a very short-term period, it's been a positive decision. But again, we're making sure that this second round of project funding is going to be remaining above 0 at the very beginning. And again, does it feel like market timing? Yes, but it's very low-risk market timing. I would rather take too little risk than too much risk with funds, especially of this nature. And so looking at performance for the total fund was just under 2% for the month. Since inception, it got back to negative 0.2% loss, so we're very close to our beginning value. Equities were strong. International equities were very strong. Our fixed income, I'm really happy that we funded the high yield portfolio, even though it's not a significant portfolio. It's not a huge allocation. It does help buoy our fixed income allocation. And cash was, it's not listed on here. It should be, but it's $30 million, and trailing 12-month rate of return is going to be somewhere around 3.5%. So that is the monthly update for July.
Okay. Any questions?
I had a quick question. I know that last month when we were talking about funding the additional 30 million, keeping it in cash and just kind of monitoring the cash returns, short-term bonds. Are there other triggers that we're going to kind of be looking at as to at which point we move out of cash back into like equities?
That is a great question. And rather than external triggers, I think we're probably going to be looking more internal. So when the initial allocation, once that gets above corpus or the principal allocation, I think that's going to be one where that would lead us to maybe take a little bit more risk in equities. But a large part, as long as the yield curve is inverted, to me, that says cash is an investment alternative, and pretty attractive one at that too. Because I look at it as an alternative to bonds right now, which the 30-year Treasury has, it's almost 4.5% right now. But at this time, given the nature of this portfolio, given our return target of 4% per year, and given the fact that we're very early on here, I mean, we have an infinite time horizon effectively. So taking it slow at the beginning is, I think it's okay.
I have one other question, and this is probably as much for Matt as anybody, but with BOK's downgrade earlier this month, I know that they've kind of provided information as to, their stability and that sort of thing. Have they provided any information to you as to whether or not there's any kind of impact for them being our custody folks? It shouldn't, from what I can tell, but just wondering.
No, in the communications with BOK, at least on that arm, there hasn't been anything significant, but they have, we do have confidence in the ability, especially on that. It's separate from it's a large bank, even though it's still not the size of some of your huge custody banks. And then those kind of top 3 or 4, they still are sizable enough to, we feel that their assets are secure and safe in there.
Okay. I know that Moody's had mentioned that there was concern about, rising interest rates and how it might affect their the loans that they have out and that sort of thing. But and I noticed that, of course, rates have gone up again. So that's the only reason I'm asking is, I know that we're probably monitoring, but I was just curious if you'd heard anything.
We can get a statement from Evan and get some of that information on the trust side.
Okay.
Great question, Bob.
Madam
Kevin.
Chairperson, I have a question in regard to the timing of when we expect to use these assets for projects around Oklahoma City, in respect to what Doug was saying around the decision to leave that much money in cash. If we were to invest that now, is there enough time for those assets to actually create value such that the alignment of when they need to be used actually matches up? I actually forgot the timing on when that distribution is, but.
Timing is part of the next item. But I think to Doug's point, and you can speak for yourself, but I think to Doug's point right now, just looking at the returns that we're getting, and I think it's 6 months, right? We did a 6-month, right. So for that short period of time, we are going to earn more just in cash than we would if we invested it. But your point is something that we need to, I think, stay in tune with. And then as that 6 month expires, what do we want to do? What does the market look like at that point, and what's the best decision, again, to your point, for the long-term growth? Okay. Other questions? If not, I would take a motion and a second to receive the monthly investment reports for May, June, and July. Please cast your votes. Motion passes. Thank you. Doug, thank you as always for being here and keeping us informed.
Very well. Thank you very much.
Thank you. Okay, moving on to item 3C, presentation of the Oklahoma City MAPS Investment and Operating Trust distribution process. Matt.
Good morning. Continuing on with the theme that Mr. Anderson had on investment reports, what a difference a year makes. If you'll recall, back in May of 22, this body approved the spending policy. Then I went back and looked. At this time last year, we were about $9 million below corpus. And so the thought of distributions was far from our mind. But as we're looking forward, those are improving. Getting with Chairperson Rose, thought it was best to bring before you a rough draft of our distribution process, because the operators will soon be requesting when are those coming through. And so we want to show you where we're thinking at that process and get any input that you might have. So per our spending policy, each year there is along with our investment consultants, we'd calculate the distribution. It would be based on a 4% average market value over the previous 12 calendar quarters. And so obviously we are not even to that point yet, but that is going to be the long-term process with that. 4% was the amount that was given, but one of the most important lines from our spending policy is that the board has discretion to alter that amount by both the dollar amount and the percentage that is available for distribution. So that's going to be very important for us. So in January, staff will work with our investment consultants to get where we are. What is that amount? In the February meeting, what we will do is present that to the trust for what that distribution amount is. We'll go through the calculations. We'll look at the long-term needs, what the market environment is doing, a lot of that timing that we were discussing earlier. February through March, we will have a form that the operators can fill out. It's a very simple one-page form, details the project name, who the operator is, whether they would, is this for operating needs or maintenance needs, and the how often they would want their distributions. They would fill that. That would come in through the finance department. It would be managed by the finance department, where they would sort through those. It is important to note, the finance director wanted to make sure we had this in consideration, that the city will be working on their budgets for in the months of April and May. The capital and operating budgets will be submitted for approval. And so we also want to be cognizant of everything going on within the city budget process during that time. When we arrive at the May meeting, that is when you would be presented then with what the distributions would be for each individual operator. And as we said in the spending policy, the trust would then have the discretion to alter that either above or below the 4% that was there, though our goal long-term is to do that 4%. And then once we get to July, if you recall, the city has a July 1 fiscal year start. We would then make those initial distributions, whether that would be quarterly or biannually, and that would be at the discretion of the operators. This is not set in stone at this point. This is just as the parties work together on this, what we're looking at, but we would also take any input or questions that you might have at this point. And there's no action item today. This is all for informational purposes.
So, questions, thoughts, feedback?
I have one question. Is there any thought or potential for reassessment of that calculated amount anytime between January and May? Or is whatever we go with in January that I guess the board approves, or
I
decides
think
to move forward with?
I think in the ideal world, they will be the same. But we understand that there will be changes. Something could happen between January and May. And the flexibility we've been given in the spending policy would absolutely give the trust the discretion to change that, alter it based on what the market environment is. But our intention would have it to be the same, but we do have that flexibility built into our policy.
Very good.
And I
Thank
think
you.
that where that will come into play is by May, when we are presented with the request. So pretty much at May is when we will need to, with obviously the consultants and staff's input, make that determination. Because what we know is that these organizations, once we make that decision, they're going to be basing their budgets and planning around that amount. So we will have a little bit of a window to tinker with it, but after May, we're locked in.
This is for 2024?
Yes. Because there are, I will just go ahead and share with you all that there are a couple of projects that have been asking when they can begin counting on the funds. Most of the projects have not, but that's part of why we were like, okay, as we're getting back up to that $80 million threshold, we need to go ahead and get a process in place so that they can begin their planning.
And while this would start January 24, it's actually what we would call fiscal year 25
Right.
budget process. I didn't want you all to hear that later and think, wait, we were told 24.
Yep.
But we start talking about next year's budget 2 years ahead at some point. So I do have a question too, and that is, will there be a standardized application form that the operators are asked to use to submit their request for distribution so we can assure that we as a body have adequate information to make that determination?
Yes, we have a draft of that as well. I didn't include that in the presentation, but we do have the one that we're looking at. It's a one-page, pretty standard form that just has the pertinent information that we would want for that. And one of the things that we've talked about is potentially in that February meeting, in that May meeting, we actually have a display of what those funds would be doing at that point.
I think it would be a good idea for that form to be shown to us fairly soon and for it to be available to the potential operators in plenty of time. We have to remember that they may not be accustomed to completing a form like that, and especially if we're asking them for certain types of information, it may take them a little time to get that together.
Absolutely, we can have that.
Okay.
I don't see any problem with having that by the November meeting.
Sure.
And so if that gives you enough time, you think, for the operators, we can certainly do that.
Other questions, comments? Okay. Jessica?
So when we do submit the forms and we ask for the organizations to begin completing it, are we sending it to just the organizations who have been asking about their allocation? We're sending it to everybody to request their allocation starting next year?
Yes, we would send this to the operators, the selected operators of each of the projects. And like I said, some of them aren't going to request. But no, we would send it to all the operators that have already been selected.
I have a question. So of the completed applications that we receive, is there like a priority? Let's say there are more applicants than we have money to distribute.
So the way that we're envisioning, and I hope y'all will understand. So we're looking at this pot of money. Within the resolution, there were specific amounts for operating funds for each project. We're moving forward like a fund accounting. So in other words, the youth centers have their pot of money, okay? And so when we look at the distribution amount, it will be whatever percentage this body determines of that pot of money. So we're not, what we don't want to do is, one, prioritize one project over the other, or two, for those projects that begin taking their allocations earlier, penalizing those projects that don't. So in other words, Boys and Girls Club, like I said, for example, they don't want to take any of their distribution for 4 years, or until their doors open. But other projects want to go ahead and take their distributions now as they're planning. We don't want to punish the Boys and Girls Club because they didn't take their money early. So we're doing fund accounting for each project for each of the each of the allocated amounts.
So what you're saying is going to be on a pro rata share,
Correct.
so.
More simply stated, yes.
And whatever they don't take stays with their fund.
Correct.
They don't lose anything. They're not
Correct.
requesting.
Yeah.
But they don't effectively potentially earn more by leaving it in there. I mean, because they
The
technically.
only more that they would earn is the growth on what they left in their fund. Right.
It would enhance their pro rata share?
Yeah, it could go up. If somebody's pulling out, if somebody is drawing money out, well, somebody else keeps, I mean, it's the compounding effect. Somebody
Right.
stays in, somebody comes out, I'm gonna have a bigger piece of the pie.
No, I understand that, but to your question, that's what I was thinking. Like, shouldn't that just be, if they get an excess above their pro rata, shouldn't that just be equally spread around?
Okay, I'm not following. If they have an excess of their pro rata,
So I think what he's asking is the amount left behind, will that continue to earn?
yes,
Okay.
yeah. But
So-
it'll still be, I mean, if it's, okay, so Boys and Girls starts with 10 million. They don't take their 400,000 for, the first couple of years. That amount is not only going to stay in their fund, but they will get the 4% or whatever that annual growth that we determine on the total amount. Does that make sense? But we're not going to say those projects that took their allocations early, they only get 3.5%. We're not going to do that. It'll be the same percentage across the board. The totals are what's going to be different based on whether a project has taken their allocation or they haven't. Does that make more sense? Okay.
So those who delay their allocation will benefit essentially?
Correct.
Okay.
Yeah. But we don't want to penalize anybody, but we want to be fair with what the initial operating and maintenance allocations were determined to be.
And truly, this is designed for the long term. So this is anticipating what this process will look like, not only beginning for fiscal year 2025, but also when we have mature projects that are there with multiple operators requesting funds each and every year. And so that's part of what with the spending policy, looking back as far, we can also be isolated a little bit from the ups and downs in the market that we can have. So we can still aim to get that 4%. Because we've had good quarters in the past, that would so we wouldn't be limited by that, because inevitably there will be recessions that will go on forward. We're trying to think for the long term on this.
Over the next 40 years, I'm guessing that prediction is correct. We may have a recession in the next 40 years. So, any other questions for Matt? Thank you so much, and we'll look for more in the November meeting. Okay. Moving on to item 3D, ratify claims from May 10th, 2023 to August 1st, 2023. Two claims were totaling $22,867.75, and this was related to the investment consulting and custodial bank services. Any questions on that? Okay. Oh. Where's my... There we go, okay. Okay, motion passes, thank you. Moving on to item 3E, renewal of agreement with ANCO Consulting for investment and consulting at an estimated cost of $65,000 for September 7th, 2023 through September 6th, 2024. Any questions? Okay,
I have
yes, Bob.
just a quick comment. Just expressing appreciation for the work that ANCO does for us. You helped us get set up. You're, a great part partner with the city of Oklahoma City elsewhere as well. I feel very confident that what we do, with your assistance is something that we can depend on. But not only that, you look at when we see opportunities to deviate, in a certain way like last month, but still ensuring that we're staying within policy, and you show how that's possible. I definitely appreciate the effort that you put into, keeping us on a straight line.
I think we all feel that way. Thank you for saying that, Bob. Please cast your votes. Okay, the motion passes. Thank you. Moving on to item 4, comments from trustees, staff, and interested parties. Do we have anyone signed up to speak today? Okay. Any comments from staff? No? Anything else from the trustees?
I just have one quick question. Remind me how many operators we have that will be submitting for an allocation.
Do you know, Matt,
Help.
how many operators?
I think, I'm trying to remember, I think there was like 8 or 9 projects, maybe 10 projects that were allocated operating or maintenance funds.
Okay.
I will have that answer for our MAPS meeting. Okay, anything else? Okay, thank you all for being here today. We are adjourned.
I should know that. I should know how many.